Welcome back to Investing Talk Podcast.
Today, we're looking at Robinhood markets.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, so Robinhood. I mean, this company has been on a wild ride.
It really has. From, meme stock darling to almost zero. And now it's looking like a potentially serious financial platform.
It feels like we're at a major inflection point in its story. For years, the market just saw this chaotic, high-growth, high-loss name.
And that narrative has completely flipped. I mean, fundamentally changed.
It's a maturity story, right? It's moved from being a startup that just burns cash to something else.
Exactly. It's become a machine that's actually capable of profitable scaling. We are finally seeing some incredible operating leverage kick in.
Which proves that the massive scale they built during that whole crazy era is now translating into, well, real efficiency.
To really get it, you have to look at the Q3 2025 numbers. They were, a blockbuster.
The numbers were just jaw-dropping.
Revenue doubled year over year. Doubled. It hit $1.27 billion.
That kind of growth at this scale it's phenomenal.
And it's the efficiency of that growth that really matters. The bottom line was even more explosive. Diluted earnings per share surged 259%.
Wow, 259
to 61 cents. It didn't just beat expectations, it blew them out of the water.
So it tells you they're not just getting new users, they're keeping costs under really tight control.
That is the heart of the operating leverage thesis. For anyone who's maybe less familiar, operating leverage is when your revenue grows way, way faster than your expenses.
You build the thing once, and then every new dollar of revenue is almost pure profit.
Precisely. And the numbers prove that gap is getting huge. Their net margin is now sitting around 52%.
52%. Think about that. For a company that was struggling with just basic profitability a year or two ago.
Exactly. Adjusted EBITDA grew between 82 and 90% year over year. But here's the key part.
Okay.
While all that was skyrocketing, operating expenses only grew between 6 and 21%.
That's the gap. That is textbook operating leverage right there.
So the platform has proven it can run much more efficiently than, the critics ever expected.
But that raises the question, all this incredible revenue, where is it actually coming from? What's the fuel?
It's coming from a renewed retail risk appetite.
Yeah.
No question. If we unpack that Q3 revenue mix, it's pretty dynamic.
Okay.
Transaction revenue overall climbed 129% to $730 million.
And the big headlines there were all in the speculative stuff, crypto and options.
Oh, absolutely. Cryptocurrency trading revenue was explosive. It surged 300% year over year.
300%.
To about $268 million in Q3 alone. The retail investors who left during the crypto winter, they are clearly back.
And we saw something similar in options, right?
We did. Options revenue also had massive growth, up 56% to $304 million.
So they're capturing both the crypto comeback and that sort of consistent high-speed options market.
But this gets to the core of their business now. And their competitive moat isn't just about, payment for order flow anymore, is it?
Not at all. And that's maybe the most important long-term development here.
Their position is getting stronger because they're diversifying. They're moving away from just depending on those transaction fees. The network effects alone are huge.
How many users is it now?
26.9 million funded customers, a massive base.
And just on the transaction revenue, for anyone who doesn't know, PFOF, payment for order flow, that's how they make money on free trades. They sell your order to a market maker.
Right. And having almost 27 million users gives them huge bargaining power in those PFOF deals.
But the real power now is turning those users into loyal customers for other things. This is that whole super app strategy.
Exactly. They are successfully moving beyond just being a simple trading app.
So what does that look like?
Well, they're expanding into 11 different business lines, pushing hard into wealth management, credit, banking services.
So they want to capture more of your wallet share.
They want to be your primary financial home, not just the place you gamble on some crypto.
And the proof that it's working is in that sticky, recurring revenue.
Look at the subscription growth. Robinhood Gold subscribers grew 76% year over year.
And how many is that now?
3.5 million members.
That's huge because it's stable. It's a buffer against the volatile trading days.
It's a critical building block for long-term stability. You can have a slow month for options, but those 3.5 million people are still paying their fee.
Okay, so speaking of expansion and stability, We have to talk about the two big acquisitions they just closed.
Trade PMR and Bitstamp, yes.
Let's start with Trade PMR. What does that do for them?
So that one is all about wealth management tech. This is key because it lets Robinhood move up market.
Serving financial advisors, not just retail traders.
Yeah, exactly. Independent financial advisors, RIAs. It's a completely different, stickier, higher margin client. A big move away from the, risk-on retail crowd.
And then the Bitstamp deal. That feels like a bigger, more strategic global play.
Oh, absolutely. Bitstamp is a massive platform. Buying it gave them immediate access to crucial crypto licenses and, most importantly, international customers.
So they can get into Europe without all the regulatory headaches.
Instantly. It makes that goal of getting 50% of revenue from outside the U.S. feel much more real.
But this all costs a lot of money. Do they have the balance sheet for it?
They do. The balance sheet is strong. The company has over $4 billion in cash.
And debt.
Virtually zero traditional debt. That kind of flexibility is a huge advantage.
And they seem pretty confident in their own stock.
Yeah, that $1.5 billion share buyback program tells you everything. Management is signaling they think the stock is undervalued, even while they're investing heavily in new platforms.
Okay, let's connect all this fundamental strength to the technicals, because the market has definitely woken up to this story.
The stock has been on fire. It's showing a really strong high beta bullish trend.
What's the year-to-date performance?
It's appreciated over 200%. And technically, it's trading very healthily above its key long-term moving averages.
So the momentum is there. What are the key levels to watch?
Well, a high range, which is acting as resistance, is around 145 to 153. But, importantly, the major support has been holding firm around 110 to 115.
So that 110 to 115 range is the line in the sand. That's where the big buyers have been stepping in.
And speaking of buyers, the analyst community has definitely taken notice. They've been pretty aggressive raising their price targets.
What are we seeing there?
We've seen targets as high as 170, 171 from some major firms. That reflects a strong belief that these earnings beats are going to continue.
And it's not just analysts. Who's actually doing the buying?
Institutional confidence is clearly broadening. Ownership is incredibly high. Over 93% of the stock is held by professional money managers.
So this is not a retail meme stock anymore.
Not at all. Recent filings show cluster buying from major players. We're talking firms like Pinnacle, Nordea, and Ritholtz all increasing their stakes. The institutional flow is heavily tilted towards buying.
Okay, but hold on. This raises a big question for me. Why would these sophisticated professional managers who control 93% of the stock pile into a name known for extreme volatility at such a premium?
It's a bet. It's a pure bet on that operating leverage story we just talked about.
They believe the path to profitability justifies the price.
And they see the stock as a high beta way to play the retail risk-on cycle. If the market's going up, retail gets excited, and Robinhood captures that excitement better than anyone.
That said, you can't say high beta without saying high risk.
Of course not. This is still a fundamentally volatile name. We have to talk about the bearish headwinds.
So what are the two biggest risks investors need to have on their radar right now?
Cyclicality and valuation. And they are tied together.
Let's start with cyclicality.
Robinhood's revenue is still highly dependent on retail risk appetite, especially in those really volatile areas like options and crypto.
And we've seen how fast that can swing. I mean, crypto revenue dropped over 50% from its peak in late 2024 to mid-2025 before this rebound.
Exactly. If we enter a general risk-off period, if inflation comes back or the Fed gets hawkish, those high-margin transaction revenues could dry up again fast.
And that risk feeds directly into the valuation risk.
Right. The company trades at a premium PE ratio, around 49 to 55 times forward earnings.
That's a rich multiple.
And it's only sustainable if this accelerated growth continues. If user engagement slows, if volumes shrink for a couple of quarters, the market could decide that a 50 times multiple is just ridiculous for such a cyclical business.
And then you get sharp multiple compression, no matter how healthy the balance sheet is.
And we can't forget the regulatory risk. That shadow is always hanging over PFOF. Any new SEC rule could instantly change their margin profile overnight.
We also have to mention the recent operational data from November. Despite that great Q3, November looked a little soft.
It did. It introduced some near-term volatility. We saw a pretty significant month-over-month decline in activity.
What were the numbers?
Equity trading volumes fell 37%. Options contracts fell 28%. And even crypto volumes, which have been surging, they declined 12% month over month.
So that's the volatility risk playing out in real time. The path forward is not a straight line up.
And this softness happened at the same time as another thing that always makes retail investors nervous.
The insider selling.
That's right. We saw several senior execs and directors, including the Buy-Shoe-Bought Living Trust, execute some pretty significant open market sales in November.
Now, to be fair, for anyone listening, these are almost always done under prearranged 10b5-1 trading plans.
Correct. A 10b5-1 plan is set up months in advance. It's a way for insiders to diversify legally. But, the optics of selling during a month when trading metrics are soft, it adds a layer of skepticism.
It's a fascinating tension, isn't it? You have institutions piling in for the long term, while some insiders are trimming under these preset plans.
The market is digesting that tension right now, and that's why the upcoming catalysts are so important.
So let's look forward. What are the key events that are going to set the direction for the next quarter?
The most critical one is the Q4 2025 earnings release. That's expected late January, early February.
And everyone will be watching to see if that November softness continued into December.
And for updates on the new acquisitions, on margin expansion and cost controls, beyond that, you have institutional flows.
The 13F filings and ETF rebalancing in December and January.
Exactly. That's going to drive a lot of liquidity and volatility. If the big funds keep buying, it could push the stock higher.
And then there are the more speculative catalysts, the high-risk, high-reward stuff.
The biggest one is accelerated international expansion, using that Bitstamp acquisition. The CEO has said the goal is 50% of revenue from outside the U.S. within a decade.
And Bitstamp is their key to that.
It's their regulated foothold in Europe. If they announce a major new country launch in Europe, that would be a huge narrative catalyst. It completely changes their addressable market.
And finally, what about product innovation? Any speculation there?
The strongest rumors are around the launch of advanced AI-driven investment tools.
Using all that data they have from their 27 million users.
Imagine if they can leverage that data to offer a truly superior personalized advisory experience. It would shift them from being just a trading platform to an investment intelligence platform. That deepens their moat significantly.
So if we pull this all together, it's a really compelling case. You have a profitable growth engine, a strong balance sheet, high institutional backing, and real diversification efforts underway.
That is the bull case in a nutshell. But investors have to go in with their eyes wide open. This is still a high beta stock, highly sensitive to retail sentiment and regulatory risk. Those sharp month-over-month swings we saw in November, that's just part of the deal.
So what's the final takeaway for you, the listener, trying to make sense of this?
What's truly fascinating here is how quickly the company has leveraged its scale and diversified its revenue base, turning that network of millions of users into a surprisingly stable, profitable platform built on top of a highly volatile core. The underlying question for investors isn't about whether they can make money now, but whether their innovations in international expansion and potential AI tools can justify maintaining that incredible premium valuation, even when the inevitable risk-off cycle returns. Subscribe for more expert analysis like this.